Let's jump right into this. Imagine for a second building real wealth without having to constantly refresh your portfolio app every 5 minutes, without perfectly predicting the next massive market crash, and honestly, without spending hours glued to financial news. Welcome to our explainer for today. We're going to unpack a pretty surprising reality. There's actually a proven, incredibly simple strategy out there that consistently beats the vast majority of investors. Like decades of data literally show that upwards of 90% of professional actively managed funds fail to beat the market over a 15-year period after fees. 90%. Yet millions of us keep trying to do exactly that. So let's look at the strategy that actually works. But right off the bat, we need to establish what this approach is not. There are no secret stocks being revealed today. We're not hunting for the next obscure tech startup in a garage somewhere. And there are absolutely no get-rich-quick promises. If you're looking to become a millionaire overnight, yeah, this isn't it. Instead, we're diving into a proven, deeply understandable approach. It's kind of the ultimate anti-hype strategy. And frankly, that's exactly why it is so powerful. Section 1. Why most investors lose. So the core issue really boils down to a clash of mindsets. On one side, you have emotional investing. We've all seen it. It's that incredibly expensive cycle of chasing whatever everyone else is suddenly so excited about. AI, crypto, maybe the hottest real estate market. But then, when the inevitable correction hits, panic selling sets in. On the flip side, though, is strategic investing. This is the pure discipline of sticking to a logical, predetermined plan that is totally immune to those sensational, flashy headlines. Because let's face it, emotions are incredibly expensive. The classic trap is buying in when you feel super excited and safe, and then panic selling the second the market takes a dip. The data tells a really stark reality here. The biggest enemy of your long-term wealth? It's not a volatile stock market. It's actually our own human behavior. Section 2, the index fund strategy. Okay, so an index fund, by definition, is beautifully straightforward. Instead of you trying to guess which individual company is going to be the next Amazon or Apple, which is nearly impossible, by the way, an index fund simply buys hundreds or even thousands of companies all at once. You're basically purchasing a tiny fractional piece of many, many successful businesses in one single transaction. It completely eliminates all that stress of trying to pick the next big winner. Think of it kind of like a sports league made up of different sectors. You've got tech, healthcare, finance, retail, energy. Now, guessing which specific team is going to win the championship before the season even starts, that's a huge gamble. But what if you just owned the entire league? You'd automatically capture the upside no matter which sector has a breakout year. As the overall economy expands and innovation happens, your portfolio naturally grows right along with it. You just own the whole pie. Section 3. 4 pillars of success. All right, pillar number 1 is diversification. Owning hundreds of companies completely insulates you from single stock risk. Think about it. If one single company faces some massive scandal, or worse, goes bankrupt, it doesn't sink your entire portfolio. You have hundreds of other successful companies acting as this massive self-balancing safety net. Pillar number 2 is low fees. And I have to say, the math here is pretty insidious. Every single dollar you pay in expense ratios to a fund manager is money that instantly stops compounding in your account. A 1 or 2% annual fee might sound like absolute pennies today, right? But over a 30-year timeline, that can literally siphon tens or even hundreds of thousands of dollars in lost growth. Index funds keep those costs near absolute zero, so your money stays exactly where it belongs, in your pocket. Pillar number 3 is removing emotion. Because the entire strategy is simply to buy the whole market and hold on to it, you never have to wake up and stress about what to buy this month. There's no guessing. There's absolutely no panic selling when the news looks scary. There's no chasing the latest trends. By keeping the mechanics constant, you effectively protect yourself from your own worst impulses. And that brings us to pillar 4, compounding. There's that famous quote often attributed to Albert Einstein that says, "Compound interest is the 8th wonder of the world." Now, whether Einstein actually said that or not, the math is undeniably powerful. Returns generate more returns. And then those returns, they create even more returns. Over a few decades, that growth becomes totally exponential. With this strategy, time is literally doing all the heavy lifting for you. Section 4, dollar cost averaging. So, dollar cost averaging. This is basically the mathematical antidote to trying to perfectly time the market. It just means investing consistently. For example, investing the exact same amount every single month, regardless of whether the market is up in the clouds or totally down in the dumps. And the reason this is so brilliant is that the math works entirely in your favor. Say you automate a $500 investment every single month. When market prices are really high, sure, that $500 buys fewer shares. But when the market crashes, that exact same $500 automatically buys you way more shares at a steep discount, which significantly lowers your average cost over time. Instead of stressing out trying to find the absolute perfect moment to buy, you're just letting time work for you. Consistency, mathematically, beats trying to achieve perfection every single time. Which brings us right back to mindset. When markets drop, say 20%, the average investor totally panics, sells everything to stop the bleeding, and then feels massive FOMO when the market eventually recovers. They end up doing the exact opposite of what actually works. But the successful investor, they see a market crash entirely differently. They see it as a mechanical opportunity to accumulate quality assets at a much lower price. Because look, while history doesn't guarantee the future, global markets have a literally 100% track record of eventually recovering from major setbacks. Section 5, your simple starting roadmap. So here is the exact 5-step roadmap drawn from our source material so you can actually put this into practice today. Step 1, build an emergency fund in cash first. This is crucial so you never have to sell your investments just to fix a broken car or handle a surprise bill. Step 2, choose a diversified, low-cost index fund that matches your goals. Step 3, set up automatic monthly investing. Just make it completely hands-off. Step 4, ignore the daily market noise. Honestly, delete the financial news apps off your phone if you have to. And finally, step 5, keep investing for years, not just weeks or months. The central lesson here is that the market consistently rewards patience far, far more often than it rewards prediction. The really crucial point to take away is that the investors who quietly become incredibly wealthy, they usually aren't the ones making loud, exciting predictions on social media. They're the ones who just follow this exact formula. It's simple, it is remarkably boring, and it is highly, highly effective. Being boring is actually your massive advantage here. It's pretty much the ultimate open secret of the quietly wealthy. Before we wrap up this explainer, I really want to leave you with a question to chew on as you look at your own financial habits. What is the absolute biggest investing mistake you've ever made? Or, if you haven't even begun yet, what is genuinely stopping you from starting this strategy today? Just take a second and think about how your own emotions might be playing a role in that. Thanks so much.